All right, welcome to the Explainer. Today, we are tackling a big one. We're breaking down one of India's toughest professional exams, the CA Intermediate Paper on Financial Management.
So if you're gearing up for this exam, you already know it feels like a huge mountain to climb. But here's the thing, it's not impossible. Not at all. With the right game plan and by really getting inside the examiner's heads, this is a challenge you can and you will conquer.
So here's how we're going to do it. First, we'll look at the exam blueprint. Then, we'll do a deep dive into the 2024 exam. After that, we'll cover the must-know core concepts, and finally, pull it all together into your blueprint for success. Let's get started.
All right, Section 1. First up, we've got to understand the terrain, right? The battlefield. We're looking at Paper 6, which is split into two halves, financial management and strategic management.
Okay, so take a look at this. The paper is split right down the middle, 50-50. Now, for our purposes today, we are zeroing in on Section A, Financial Management. That's 50 marks, and you can see it's broken down into 15 marks for multiple choice questions, those are usually heavy on calculations, and 35 marks for descriptive questions, which are a mix of theory and, you guessed it, more calculations.
Okay, moving on. Now, let's see how this all works in the real world by digging into the May 2024 exam. This is where it gets interesting, because by looking at the actual questions, we can start to decode the examiner's mind. We can figure out what they're really after.
So check this out. The very first question they threw at students, it wasn't some simple plug-and-chug formula problem. No way. It was a puzzle. They gave you a few financial ratios, a couple of other data points, and basically said, okay, now work backward and build us the financial statements. It's like being a detective. And this shows you exactly how to crack it. It's like a domino effect. See, you start with the debt-to-equity ratio to figure out the equity. Got it? Okay. Once you have that piece, bam, it unlocks the net profit. Then, that net profit figure lets you calculate the EBIT, which in turn helps you find the sales number. You see that? Every single answer becomes the key to the next part of the puzzle.
So what's the big takeaway here? It's that just memorizing formulas is going to get you nowhere. You absolutely have to understand how the income statement and the balance sheet talk to each other. They're connected. You got to think like a financial detective, putting all the clues together.
All right, next case. Here, they put you under pressure with a scenario analysis. They basically asked, what happens if sales suddenly drop? How bad is it going to hurt the company's profit? And more importantly, the earnings for each shareholder. This is all about analyzing risk.
So the way to solve this is to actually build a few different income statements, one for now, and then a couple more showing what happens if sales fall by 15 or 20%. What this really demonstrates is the power of leverage. Because of fixed costs, leverage is a double-edged sword, right? It makes the good times great, but it makes the bad times so much worse.
And why do they test this? Well, it's simple. The examiners need to know that you get the big picture. They want to see that you understand how a company's cost structure, its fixed costs, creates risk. It's all about connecting the dots between fixed costs, the break-even point, and what the shareholder ultimately gets in their pocket. And for the final part of this big question, they hit you with a classic business decision. It's a real-world problem. Should our company handle collecting its own invoices, or should we just sell them off to a factoring firm and let them deal with it?
Now, this is way more than just a math problem. It's a strategic choice. And the key is to think purely in terms of cash flow, what comes in versus what goes out. So, just like you see here, you line it all up. You calculate all the benefits, the money you'll save. Then you calculate all the costs, the new expenses you'll have. You subtract one from the other, and boom, you have your answer.
So, the big lesson here is all about structure. You have to lay out your answer logically. Make a list of all the benefits, all the costs, and you've got to pay super close attention to the details. See that term, non-recourse? That's a huge clue. It means the factoring company takes on the risk of bad debts, which is a big saving for your company.
Okay, so we've dissected that one massive question. Now let's zoom out a bit and talk about the other core concepts, the theoretical backbone of this entire subject. You've got to know this stuff cold.
Right. Let's talk about the heart of corporate finance, the weighted average cost of capital, or WACC. Just think of it like this. It's the hurdle rate. It's the absolute minimum return a company has to earn on its investments. If a project earns less than the WACC, it's not just failing to add value, it's actively destroying it. And when you're calculating this, oh man, the details matter so much. You've got to master the CAPM formula to figure out the cost of equity. And please, whatever you do, never, ever forget the tax shield on debt. Interest is tax deductible, so it effectively costs less. That's a classic trip-up spot on the exam.
Okay, so when you're deciding where to put the company's money, you'll be tested on two main tools, NPV and IRR. Now, IRR gives you a nice percentage return, which is cool, but net present value, or NPV, is really the gold standard. And here's why. It doesn't give you a percentage, it gives you a hard number. It tells you exactly how much cash value a project is going to add to the company. That's what really matters.
Next up, dividend policy. Walter's model is a neat little framework that helps answer a really fundamental question for any company. What should we do with our profits? Do we give them back to our shareholders as dividends, or do we keep the cash and reinvest it to grow the business? And the logic behind it is actually super simple but really powerful. Look, if the company's return on its investments, that's R, is higher than its cost of capital, that's KE, it means the company is better at investing that money than the shareholders are. So in that case, what should it do? Keep every single penny and reinvest it. The optical payout is 0.
All right, we have covered a lot of ground. We've looked at the exam, we've gone through the core concepts. Now let's wrap this all up into a straightforward, practical study plan that you can actually start using, like, right now.
Look, the smartest way to study is to prioritize. Use this ABC analysis. The topics in Category A, these are your non-negotiables. I'm talking investment decisions, working capital, cost of capital. This is the heart and soul of the exam. You have to master these first. Nail these down completely, and you've already built a super strong foundation.
And finally, let's talk tactics. You need to combine that focus with some smart study habits. First, the official ICAI Study Material, that's your Bible. Second, you have to grind through at least 5 years of past papers, RTPs, and MTPs. Third, become a wizard with your calculator's memory functions. It'll save you so much time. And maybe the most important tip of all, keep an error log. Go back and analyze your mistakes. Seriously, learning from what you got wrong is the absolute fastest way to get better.
So there you have it. We've given you the blueprint. We've decoded the exam. We've gone over the core concepts you need to know. The path is laid out for you. Now, what's your strategy for success going to be?